All right, guys, let's quickly take a look at the UK wage data, labor data coming up at 7 a.m. UK time. Now, this one is going to be interesting for the markets tomorrow because if we quickly take a quick look at market expectations here, we can see that right now, that September meeting is up for grabs in terms of whether there's going to be a higher probability for a cut or a hold. It will largely depend on a lot of the incoming data, obviously, that we get, not just this month, but next month as well. But it'll shape the market's expectations going into that meeting. Right now, there's about a 40-60 chance, which I do think is slightly too hawkish for the markets here. I think there's a greater risk that cut expectations increase, but again, that's all going to be based on the data, right? If the data comes in super hot on wages and in CPI, then obviously it'll increase the probability of a hold a lot more. But I do think, it should be swapped around at this stage, in my opinion. But anyway, let's see what the data shows us. The bottom line is it will be important, a little bit more than usual, because the market's unsure what's going to happen in September. And if it's a super hot number or a super bad number, that will influence how we, how the markets change expectations. And obviously, if we were to go from pricing in a higher probability of a hold to pricing in a higher probability of a cut, when you have those types of flips in terms of market expectations, you generally tend to see slightly bigger reactions in the markets as well. So it could be good for sterling to trade on the short side. I think trading it on the short side will be a much simpler trade to have tomorrow. However, it could be possible to trade it both ways. It could be possible to trade sterling higher. I'm not a big fan of doing that right now, because if you look at positioning information, pound is still at very historical stretch long territory right now, which always makes it a little bit risky on trying to chase it higher. But if we look at the amount of downside that we've had in sterling in a very short space of time, given that recent risk of momentum that we had, we do have some room to run to the upside, right? So it could be tradable, but because positioning is so stretched still, and because the markets have been bullish sterling for quite a while, and because the market's already leaning more towards a hold compared to a cut, my preference would be to trade it lower if we get a big miss. I just think that's going to be a simpler trade to be had. And it also means that the bar is much higher to get us to buy sterling on data compared to getting us to short it on bad data. The data needs to be much better for us to buy it compared to how bad it would be for us to sell it, right? So that's important to understand about positioning and how we're looking to potentially trade it. So it's tradable both ways, but I will need to see a much bigger deviation on a beat compared to what I would be willing to trade on a miss. Now, something else just to quickly keep in mind about the UK wage data, like we've been saying over the course of the last few months now, remember right now, the Bank of England can't really trust and don't really trust the employment change data and the unemployment rate data, because the ONS is still busy with their new methodology. They're trying to figure things out still. They're trying to get to a better sample size. And they've told us that we can only really start to look to trust the data again, the employment and the unemployment rate data, that is, going into November-ish this year. So until the Bank of England starts to trust that data again, and until the market starts to trust that data again, it will be very easy for the markets to discount whatever we get from these two numbers compared to what we get from the wage numbers. So that means that if wages were to surprise massively to the downside, but the unemployment rate comes in really good, also lower, the markets might be able to discount the unemployment rate and rather focus on the lower wages. Or if wages comes in much higher, but the unemployment rate comes in higher as well, then the markets again might be more swayed about the stronger wage numbers compared to the higher unemployment rate. Ideally though, we would want to see as many of these measures showing us the same thing. So if the wages comes in super low, we obviously want to see the unemployment rate surprise to the upside. So all of them coming in negative basically. Or if wages comes in really hot, we want to see the unemployment rate moving down, right? Because remember, the lower that is, the better it is, the higher it is, the worse it is when it comes to the unemployment rate at least. So we'll be looking for all three of those things, those key components, to show us the same thing basically. So with that said, what type of numbers are we looking for to trade? So let me just grab the scenario planning here for the print, and let's quickly bring up the forecast distribution here for the unemployment rate. Let me just quickly open that up for us to take a look at what type of data we are considering for a trade. So Oh, sorry guys, let me just bring that back. Here we go. That's it. So in terms of the unemployment rate, I'm going to keep it very simple. Market expectations is for it already to go from 4.4 up to 4.5. Numbers I'm looking for here in terms of a dovish outcome, I'll be looking for 4.6 or higher. Why 4.6 specifically? Well, it'll be firstly above the market's maximum expectation. More importantly though, at 4.6, we will be coming in right on top of the bank's estimate for what they think the unemployment rate will be by Q3 of 2025. So that is their next year Q3 estimate versus the current one of 4.4. So at 4.6 or higher, obviously, but at 4.6, that'll put the bank under a bit of pressure saying, hey, the number that you thought you were going to be at, in Q3 this time next year, we're already there. So that anything higher than that, 4.6 or higher, I think should be good enough to surprise on the dovish side. What about the hawkish side? There I'll be looking for a number that's 4.2 or lower. Why? It's below the market's minimum. I think if we're going to gun for a beat, like I said earlier, a beat needs to be much better in terms of the size of the deviation we're looking for compared to just, looking for a miss. Even though 4.3 already will be an outlier, I think 4.2 is what I would feel comfortable with looking for a possible trade. So what about the next number then? Let's look at earnings 3-month year over year, and let's just quickly bring up the forecast distribution there. So in terms of earnings 3-month year over year, it's important to understand that this is already expected to decelerate meaningfully from the prior number. I mean, in fairness, the whole jobs report is expected to show a deteriorating or at least /normalizing labor market for the UK. You can see everything is expected worse. Unemployment rate expected at 4.5 from the prior of 4.4. Employment change expected at 3 from the prior of 19. 3-month year over year earnings expected to go from 5.7 to 4.6. I mean, more than a percentage point drop. That's a lot. And ex-bonus expected to go from 5.7 to 5.4. So there's already that expectation, that broad expectation of a softening of the labor market. So in terms of the 3-month year over year number that I'll be looking for here, I'll be looking for 4.4 to keep it simple. It's firstly a number below the market's minimum. It's going to be a very clear outlier print for this one, and it's going to be way below the market's prior. So anything below 5.7 will already be below the prior. But because there's such a huge cohort expecting this to come in at 4.6, I want it to be big enough to surprise all of these players as well. So a number below below 4.5, or let's say 4.4 or lower, I think that should be good as a possible miss. And in terms of a hawkish surprise, again, this one is a little bit tricky because even though the markets are expecting this to move lower to 4.6, and theoretically speaking, anything above that will be seen as a beat, I won't be comfortable trading any of those as a beat. Why? Because anything below 5.7, taking a look at this chart, that's your wage numbers. And remember how closely correlated right now it is with services inflation. This really matters for the likes of Pearl, for the likes of Man. So the markets will be paying attention, right? So I don't want to see this printing at, let's say 5%. Because yes, even though that'll be a big surprise versus market expectations, market expects it to drift down to 4.6. So if it comes in at 5, it'll be a big surprise, yeah. But at 5%, you are still seeing a 0.7% deceleration in wages, which makes it tricky to trade because, yeah, you're better than expected, but wages is actually moving in the right direction still, which makes that tricky. So that's why I said earlier, the bar to surprise on the upside for me needs to be much higher. So that means ideally we want to see 5.7 or higher. Why 5.7? Because firstly, it's in line with the prior, which means that it shows no disinflation for wages while the markets are expecting a huge disinflation move from 5.7 to 4.6. If we don't get that and wages stay at 5.7, that'll be pretty bad, right? At least in terms, in terms of what it means for the Bank of England. They would need to stay hawkish, arguably, or would want to stay hawkish a little bit longer if we get wages going nowhere, staying there at 5.7. Because again, that places more sticky risk to the services inflation number, which is very important for them right now. So to summarize, 4.4 or lower for a miss. and 5.7 or higher for a beat. Now, in terms of the exponents numbers, there we know the markets are expecting to drift down from 5.7 to 5.4. In terms of the forecast distribution there, let me just bring that on the screen as well. Here we'll be looking for a number that comes in at 5.2 or lower. Why? It's firstly below the market's minimum of 5.3%, but anything below 5.7, once again, will be a new cycle low. And what I also like about 5.2 is that even though 5.3 is a bit of an outlier here, it's not as big of an outlier compared to the upside. Can you guys see that? So because there's such a big chunk of them expecting 5.3, I want to see it coming in below this as a minimum. So 5.2 or lower, I think, is what I would be looking for there for a miss. And in terms of the ex-bonus number on the hawkish side, again, 5.7 or higher. Why? In line with the prior, and again, shows no disinflation when the markets are expecting a clear, big deceleration here in that wage number. So those will be the numbers I'll be looking for. What is the expected reaction across majors? If it's a dovish outcome, we expect pound downside and gilt yield downside. For a hawkish outcome, we would expect pound upside and gilt upside. Now, gilt yield upside rather. Now, in terms of an inline outcome, we normally don't expect much from an inline print, right? If it comes in line with expectations, that normally doesn't move the needle. But what's important here is that even if we get in line with expected data, that will still show us a decent deceleration in wages, and that could see some marginal pressure playing into sterling, even if it's an as expected print. Because again, take a look at this. If we go from 5.7, where's that data? Here we go. From 5.7 to 4.6, even at 4.6, that's a big move lower. It's moving in the right direction. Unemployment rate moving in the wrong direction. Average earnings 5.7 to 5.4, obviously moving in the dovish direction. So even though an as expected shouldn't normally trigger reaction from the markets, I wouldn't be surprised to see sterling push lower on an as expected number, because again, that'll already show us decent deceleration. It won't be enough to give me conviction to trade it, but I wouldn't be surprised to see that as a possible reaction. So assuming we get a dovish outcome or the ideal hawkish outcome, what can we look to trade? I'm going to keep it simple. I'm going to stick to euro sterling for both of them. Why? Euro sterling, it's like the Aussie Kiwi. When it comes to Aussie and Kiwi data, it's a very good pair usually to look for differential plays. And the same story with euro sterling. When you get big deviations in Eurozone and UK data, euro sterling tends to be one of those pairs that's a good differential pair to look to trade that against. Not always. You have to obviously assess the situation. But I think euro sterling could be interesting both to the up and to the downside right now. Let me show you guys why I say that. We obviously had a huge move. To the upside in this pair over the course of the last, few sessions. But take a look at where we're trading right now, right on top of the 200-day moving average. A lot of that differential upside risk that was building up for the pair, a lot of that is now basically out of the way with this big push to the upside. And the pair, with that in mind, is arguably trading slightly now more neutral in terms of the upside risk that was playing out or that was suggested by market internals like yield differentials and growth differentials and commodity differentials and risk reversals. We've basically, I think we are now closer to neutral than we were back at the lows. So if we get a huge downside surprise in wages and an upside surprise in the unemployment rate, i.e. a bad print, that ideal dovish print, I wouldn't be surprised to see more upside here for euro sterling, because we're sitting and hugging right on top of that 200-day moving average. The markets have basically broken above it, came right back down to test it. If we get really ugly numbers from the UK tomorrow, I wouldn't be surprised to see sterling pushing up. Areas that I will be aiming for there, obviously the implied volatility levels will be important for tomorrow. And we will obviously, we'll have the updated data tomorrow, but it should be fairly close to these levels depending on where we close. So obviously looking for something, I would say close to 85, let's say 85.80 could be on the cards, above that 86 flat. But ideally we would want to see a rotation back up towards these recent highs at 86, let's call it 86.040. I think that could be a good area to consider to the upside in the case of a dovish print. In terms of a hawkish print, why would we look for downside? Well, firstly, it's not common for this pair to move this amount in such a short space of time. Not every differential, but there are some of the differentials that has responded to this move saying, whoa, we actually think there's a little bit of downside risk here for the pair, especially if you look at things like, let me quickly see here. If we look at, I'm going to try and move this chart over. I'll share it a little bit later. Can't seem to push this over, but we can look at it this way. Take a look at this. If you look at just yield differentials itself, haven't really caught up to that move just yet. That does show some potential downside risk here. We also have the same thing, I think, with the inflation expectation differentials. Also, growth differentials have been suggesting downside as well. So you've got some of them suggesting up, some of them suggesting down, which again, hence is why I say there's more of a neutral bias now, which means if it's a hot number, that 5.7 we're looking for wages, and a 4.2 on the unemployment rate, I wouldn't be surprised to see euro sterling testing lower again. And there we could just aim for the lower numbers. 85.40 seems like a good area to aim for. We might be seeing the second low coming in at that low. Yeah, I mean, aiming for 54.50 and then 85.50 and 85.20 to the downside seems like good options. So I think it's tradable both ways, this one. The other one that we could potentially consider if we get a dovish outcome could be something like a pound CAD short. Why a pound CAD short? I mean, technically, the pair finally gave up that huge level around 176. We bounced right on top of that next level of support. Now we're just kind of meandering around that 175.50. In terms of positioning, these two currencies are at opposite ends of the scale. You've got pound massively stretched to the upside. You've got the CAD sitting on the biggest historical net short position going back to the data that I have for the CAD, right? So that could potentially be a bit of a mean reversion trade to the downside. We've got some really key levels to aim for there as well. Implied vol low coming in close to the low from 2 sessions ago. Prior level of support and resistance around 174.50. Below that, you've got 174, then 173.50. Nice round numbers and some confluence there to the downside. It would have been great to potentially trade sterling versus something maybe like the Kiwi as well, or maybe even the Aussie. The only thing that I have against those is we're going into big events for both of those, right? We're going into the RBNZ on Wednesday. We have Aussie jobs data on Thursday. I would prefer to maybe wait for those two before trading that, but that could also be an option if you are not skittish, going into those data points in terms of the Antipodean. So that's just a quick look at what I'm looking for that UK wage data. Let's hope we get some really big deviations so that it makes it worth our while to potentially look for a trade in those data points.